Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. Also in the room is my colleague Victor. How are you, Victor?
Very good, very good. As committed to tell you about the US dollar as possible.
I always look forward to your views on the US dollar, and we will look at a few currency pairs like the dollar yen, euro dollar certainly, and pound dollar ahead of the Bank of England's policy decision. So it'll be interesting to hear your
Is
thoughts on
that
the
today or?
No, it's on Thursday.
Thursday.
Yeah. So obviously, for those of you who are here, welcome to today's webinar. Make sure you ask us questions. Maybe leave the questions towards the end of the webinar. But for those of you who are watching this on YouTube or elsewhere, please consider joining us live next time so you can ask us questions, and we'll be more than happy to provide analysis on any particular market that you guys are interested in. Okay. So before we begin, obviously it's important to be aware of the risks involved in trading. So I'm going to read the first paragraph. Please make sure you understand the risks involved. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investments based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Right, so just a quick reminder then, this webinar is taking place every Tuesday at 11:30 London time. And we will be talking mainly on technical analysis side of things, but as Victor mentioned, we also provide some fundamental views on the major currencies and stock markets and so on. There will be a Q&A at the end of the webinar. Now, here's the key macro events coming up before we look at the live charts. On Wednesday, we have the New Zealand employment data, first thing out of Asia. Then we have the PMI data from European countries. Bear in mind this, it will be like final PMIs for the major European countries, but flash for Italian and Spanish services PMIs. From North America, we have the private sector payrolls report, ADP, and the ISM services the ISM services PMI on Wednesday. On Thursday, there's a couple of not so important economic pointers out of the Eurozone. But the main focus will probably be on the Bank of England policy decision, which we will talk about in a bit of detail later on. Friday, then, we'll see the release of the US jobs report. We'll also have the Canadian employment report released at the same time. Ahead of those employment reports, there will be some Chinese figures to look forward to during the Asian hours. And then early in the morning in Europe, we'll have German industrial production. So plenty of macroeconomic events happening this week, on top of the ongoing company earnings releases that will be coming in throughout the week. There'll be lots of European companies reporting this week, and the focus is shifting to Europe now and away from the US, with big US companies have already reported their results, or most of them anyway. But there will be a few others that will be reporting, starting with Pfizer today and a few others later on in the week. Anyway, let's crack on then and go straight to the charts. So the dollar has, we're going to start off with the dollar index. And the dollar has started the new month on the front foot after falling consecutively during April.
In April,
yeah. And it's broken its bullish trend here. So sorry, it's bearish trend, I should say. What's caused the dollar to bounce back, Victor? Then.
So we have seen the kind of the worst of the European data, I would say,
Okay.
over the past few weeks, and the market has been pricing in that the vaccine distribution in Europe is now
Yeah.
on track,
Yeah.
and basically the euro has benefited from this. So as we know, this is the biggest component when it comes to the US dollar index, the euro rate. So
Yeah.
this is what has been going on over the past few weeks. So the market has been pricing in a rebound in the European economy. I
Yeah.
think that at this point in time, that theme is fully priced in,
Mm-hmm.
and the next leg, higher or lower in the dollar, will once more focus on U.S. data and U.S. prospects, as well as U.S. yields.
Yeah. Just as you are talking about the yields, I just brought up the chart of yields. It looks like yields have broken out of a wedge pattern to the upside. Well, they did break out last week, but there wasn't much immediate follow through. But now it's finding support at the retest of the trend line in this green shaded region. And do you expect yields to continue higher from here?
Well, considering the survey results yesterday
Yeah.
that were published by the ISM,
Manufacturing PMI.
the manufacturing
Yeah.
PMIs are the price components of those were
Yeah.
insanely high.
Yeah.
We were seeing inflation all over the board. I think that the market is sooner or later going to start pricing
Oh
in
wow! Look at that. Yeah.
an increase in rates,
Mm-hmm.
possibly much sooner than the market currently expects.
Yeah.
Because these prices, folks, they are uh, they're actively going to impact consumers at some point in time, where it might not be immediately,
Yeah.
as the savings rate is currently relatively high.
Yeah.
However, considering the pace of price increases, if this is not like we have heard, we've been hearing from the Fed that this is the current price increases are due to base effects and due to transitory factors, as they call
Mm-hmm.
them. However, if that doesn't prove to be the case,
Yeah.
which I don't think it will, we're off to the races, and we're going to need higher rates in order
Yeah.
to have a sustainable economy.
Yeah, I mean, inflationary pressures are building everywhere. I mean, you know, just going back to the ISM PMI, manufacturing PMI, if you look at the um, components of prices paid, it's risen 4 points from the previous month to almost 90. Quite a sharp rise. And this is all due to input costs rising. And if you look at commodity prices, for example, crude oil has been rising rapidly, both the US and Brent crude. Looking at copper, for example, has broken out to the upside. If you look at corn prices, look at this. It's just amazing, isn't it? Wheat also rallying. Soybeans. And a few other ones as well, which I think I have somewhere here. Yeah, and cotton prices. So you get the picture. Commodity prices are rising rapidly, and all of that is increasing the pressure on inflation, really, not just in the US, but across the I'll say across the Western regions of the world, including.
Well, I would also say across emerging markets, particularly because
Yeah,
their currencies, like currencies in countries like Turkey and India,
yeah.
they have suffered dramatically over the past several,
Yeah.
quarters,
Yeah.
and
This is the Turkish currency against the euro,
yeah,
and you said the Indian rupees, yeah.
yeah, the Indian rupee is also under pressure because of the dire situation with COVID over there.
Yeah. Actually, the US the Indian rupees are doing somewhat better than you would expect. In the last several.
It's still doing well
Yeah.
on a longer term basis.
Oh yeah, on the longer term basis, massively down. Yeah.
However, the current situation with COVID and the shaken confidence in the Indian government is a risk factor that we should not ignore. And these countries are likely to need higher rates faster than the Western world. So this might be a reason for.
Yeah. Thing is, though, with the case of Turkey, certainly the government there doesn't like higher interest rates. That's going to be an issue, isn't it? Because every central bank head that has attempted to control inflation by increasing interest rates, they have literally been sacked by the government. So that's the dilemma facing the Turkish economy in particular. How do you bring down inflation without raising interest rates? Is a dilemma, and without getting sacked.
Yeah, well, there is no dilemma. They simply won't bring them down. I mean, they won't bring inflation down.
Yeah.
So we'll see how that. I mean, this has the risk is that this can translate into a full-blown financial crisis if emerging markets fail to raise rates. And this could squeeze them very, very hard because they have a lot of debt denominated in US dollars. So if they don't raise rates to defend their currencies, I don't know. It's damned if you do and damned if you don't.
I mean, like if you raise interest rates,
if you raise rates, you'll kill inflation. You'll be fine. But if you don't raise rates and you want to repay your debt, it's crazy, man.
It's
either way, it's a huge problem for emerging markets, I think.
Indeed. Yeah, so that's a key risk facing the markets, which the equity markets aren't really pricing in at the moment. If you look at the major indices, they have come down a little bit from their recent highs, but they are German DAX still not very far from its record high that was hit last week or a couple of weeks ago. Same with the S&P 500, still near the top upper end of its recent range. Technology stocks have come down a little bit in recent times. The Nasdaq 100 here. But it still remains very near the highs. So that is something that could possibly hurt equity markets if we do see an emerging market currency crisis once again. But some of the emerging markets are in a crisis, but if we see an acceleration in that trend, then that could possibly impact the equity markets. But going back to the forex markets, and we touched on the dollar index. The dollar has risen for the last couple of sessions. Or yesterday it was down, but it's bounced back today, and it's broken the bearish trend line. So from a technical point of view, this is somewhat of a bullish development, I would say. Particularly if you look at the shape of the candle from the previous week when the dollar index formed a hammer candle. However, well, what I am, well, I'm not worried, obviously, but what I would say is the location of this hammer on the weekly is formed right at resistance or ahead of resistance, the shaded region here, which was previously resistance and support. And so the fact that this apparently bullish signal has been formed right at or near resistance could be a trap to get the bulls involved once rates break the previous week's high before it goes back down, possibly. So that's a key risk from a trading point of view to consider. So keep an eye on the previous week's high. And what you want to do is have this level delineated on all your charts. So for example, if you don't look at the weekly, but you should have that level on the daily or the hourly time frames, like I have done so here. So what I would be wary of is a possible false break above this and then a move back below to push us back down. That could happen despite everything we've mentioned, because the ongoing trend is still risk on, right? So we may see the likes of the pound, the euro, Aussie, all of that might bounce back if sentiment towards risk assets remain positive. So that's a key risk to take into account. But you know, going into these currencies one by one, the euro is going to be interesting to watch. Well, I say interesting, but it's still stuck inside a range, I would say. And what I would be looking for is what happens around this 120 psychologically important level, which is being tested as we speak right now. This 120 handle has been really important. As you can see, previously the euro has bounced from that level, both when it tested it from underneath and also from above. We recently broke above it, tested it here, and it bounced. It's come back down again, testing it. Will we go back up from here, or will we see a breakdown? So if it holds above, then the path of least resistance would remain to the upside, and that's the longer term trend. In which case we may see a move up to 122, possibly a lot higher, maybe 123.50, the previous high, in the days ahead. Whereas if the 120 handle breaks decisively this time, then at the very least the 200-day moving average will be tested, I think. And then from there, it's anyone's guess really how far this could fall. The pound is looking a little bit more bullish than the euro, which is not a major surprise because the UK economy is in a much better position right now. They have been very successful in vaccinating its population, and that has, along with the lockdown measures, have helped to bring down the infection rate drastically. Deaths have fallen as well, and the government is making plans to, fully reopen the economy in the next couple of weeks to months. So things are looking positive for the UK economy, and that's being reflected in the pound going up across the board. Now, against the dollar, it's going to be interesting because obviously, as we mentioned, the dollar has bounced back across the board. And so we are talking about two strong currencies playing against each other here, which may mean we will be stuck in a consolidation for a while. But I think the pound is still edging it over the euro, over the dollar, in my view, because, we've broken out of this bearish channel. Price came down to retest the breakout area here, and it bounced, came back down on Friday really sharply, and took out the previous low. But equally impressively, it has bounced. It bounced back on Monday before hitting resistance at 139.30, the head of this small inverted hammer candle. From there, it's fallen. Now it's testing the 21-day exponential. So it's kind of stuck in between a rock and a hard place. Which direction will it break out to? Well, to some degree, it may depend on the outcome of the Bank of England policy decision, which is on Thursday. Now, inflationary pressures are rising across the world, but also in the UK. And the Bank of England may signal its intention to tighten monetary policy in the months ahead, or maybe not. So that's what the market are kind of waiting for, to see what signal the Bank of England will give on Thursday. So I reckon a break above a break above Friday's high, when we saw this big down move, a break above that level at 139.58 would be bullish in my view, because it would invalidate the bearish scenario. Surely price shouldn't go above that level after what was a really bearish day on Friday. So if price were to go above it, people who sold on the back of this will be exiting their trades, I think. And that could lead to a quick move up to the 140 handle, where the cable has previously found a strong resistance. But this time it may break through it and go on to reach a new high for the year in the days and weeks ahead. In contrast, if we break back below the 138.20 handle, this low here, we've tested this a couple of times, and so far it's holding above. But is that a breakdown in market structure, or is that a false break below the previous low? So if price were to come back down below this level, it would confirm that it was a market break structure, a break in market structure, meaning that we could see fresh technical selling below that level in the days ahead. So those are your key levels to watch. Depending on which one gets breached, we could see some follow on technical buying or selling above or below those levels. But my personal view is that I would rather play the long side than the short side, because of my positive outlook on the UK economy. Now, if you're bullish on the pound like I am, and you're concerned that the dollar strength will prevent it from breaking out, then it's perhaps better to play the pound's strength against a weaker currency, a currency where the central bank is not too concerned about rising inflation. For example, Japan, right? So in Japan, lack of inflation has been a massive problem over the last couple of decades, I would say. And so with inflation finally picking up across the global economy, I think the Bank of Japan will be relaxed about it. They will want inflation to rise, which means they are not going to be in a hurry to tighten monetary policy. So I reckon the Japanese yen is going to struggle, as in it's going to weaken against all the major currencies, unless we see a massive risk-off tone come into the markets in the next few days. But barring a massive risk-off response in the equity markets, playing the Japanese yen against the dollar, against the pound, are one of my favorite kind of trade ideas, if you like, right now. So looking at the dollar yen, it's broken this head and shoulders area, well, just about. Yesterday tried to break through it. It failed and closed back below, but today it's having another go at trying to break through this resistance area. If it successfully manages to clear here, then as a minimum, I think rates were likely to reach for liquidity resting above the March high at 111. That would be the next bullish target for the dollar yen. And I mentioned the pound. Let me just clear everything. Yeah, the pound is holding up quite well against the Japanese yen, and if I draw a couple of things here, you can see that it's broken above this wedge pattern here, tested the trend yesterday, and it's bounced from there.
The trend line, and it has remained bid.
Yeah.
That test, yeah. So yeah, there is a sense, certainly, what you're saying. If you want to short, if you want to go long on the pound,
yeah,
your safest bet is the weakest currency, and that, without any debate, currently is the Japanese yen.
Absolutely. Do you think? Do you know of any other ones that may be weak right now? Maybe the franc, pound against the franc, perhaps.
The Swiss franc, yeah, I
maybe
think
not.
that chart is also constructive. Although the franc has
not as much as the
retained,
yen.
yeah, the franc has retained its relative status of safe haven. So yeah, despite the fact that we are in risk-on mood, the franc is not getting dumped as one would expect.
Even against the US dollar, it's kind of remained.
No, against the dollar, against the euro, I think that's. Oh no, the euro Swiss franc.
The euro Swiss franc. Okay.
Yeah.
Oh wow. Okay.
The 110 level, 110, 111 area has proven to be quite a hurdle for Swiss franc bears. So
yeah,
at this point in time, I wouldn't bet against the Swiss franc, because the moment you get some jitters, risk off mood comes back to the market. You could see a rally in the Swiss franc.
Yeah, certainly that's the key risk for the franc. So any other markets that is catching your attention, Victor, at the moment?
Well, oil has been behaving oddly over the past few weeks, I would say. It broke through. Like there's been a really choppy price action across the board, and it's really difficult for shorter term traders. However, now that we are approaching the big levels up there, the 2020 high at 71.20 and the $70 mark in Brent, which is, as you have pointed out, a psychological level. We might see some action there. I'm not sure whether the reopening of the economy hasn't been fully priced in. I tend to think it is.
That's what I think as well. That it's kind of fully priced in. It could be a supply story as well, because the OPEC plus, they're being reluctant to ease their
to raise output.
To raise output. They've been quite reluctant, which has tightened the market really, and that as well as ongoing optimism about a strong recovery in demand has helped to keep oil prices quite high. And
so but we might be getting to the point where shale oil producers are starting to come back into the market and ramping up their production, basically serving as a to counterbalance the the output cuts from on part of OPEC countries.
Yeah.
So
And the OPEC will be expecting that as well, which means that they will be more inclined to start easing their supply curbs sooner rather than later. Otherwise, they will lose market share.
Yeah, exactly. So
especially Russia, I think they're more concerned more than the traditional
more than the Saudi
OPEC. Certainly more than Saudi.
wing.
Yeah. And also Iran supply is going to increase as well if sanctions are lifted.
This is the other key development that oil traders should be looking at. These are the ongoing negotiations regarding a new Iran deal.
Yeah.
Nuclear deal. So that's a complex factor to watch for.
Yeah.
You can't really predict what's going to happen, but you would think that the US wants to get Iran back on track and kind of try to make Iran forget about what happened during the past 4 years with Donald Trump and so on. Not sure that's going to happen, and I'm not sure it's going to be easy, but let's see.
Just to wrap things up now, I'm just going to touch on gold and silver and maybe Bitcoin and Ethereum maybe, and then we'll wrap it up. Gold is still trying to find support, but struggling really to move away from this support area because of yields being near their recent highs.
Yeah,
and the dollar has come back as well. And so silver is looking at somewhat more bullish now because of the. Sorry, do you want to take over this?
Yeah. So silver is looking strong as it bounced up from the 200-day moving average area and is currently testing the 120. The 27 area. We have had a break above the 26 and 26.50. So if this move is sustained, I feel that silver could continue on and test the recent highs at 28.50-ish, something like that, and the $30 area, which is the ultimate target for silver bulls. What you would certainly be looking for in terms of catalyst for silver would be, again, interest rates, as Fawad already mentioned, and the gap in inflation, the gap higher in inflation that is certain to pressure the Fed at some point in time. We just don't know when.
Absolutely, yeah.
So you've put up a Bitcoin chart briefly?
Yeah. I thought you was going to move on to Bitcoin, so I jumped ahead. This is the Bitcoin chart, daily chart here. What do you think from here? Higher, more higher, or?
If you point a gun to my head, I would go short.
You'd go short.
Yeah, I think so.
Okay.
This is not the ideal condition to make a decision.
Yeah.
With a gun to your head.
No, absolutely.
But
I don't have a gun, by the
way. I haven't been very bullish on Bitcoin ever since that breakdown and the higher high, which was followed by a lower low. Below 50,000. I'm not really. I can't. We could see a retest of 60,000, I think. But anything above there, I don't think is gonna last much. And we also have this regulatory risks, the financial bubble risks, all the craziness that's going on with Dogecoin, which is bigger than the Ford Motor Company.
Are you serious?
Yes.
Okay.
The market cap of Dogecoin, which is a coin that doesn't serve any practical purpose, is unlimited in its there's
Supply.
it's not supply capped as Bitcoin or whatever. There is an unlimited supply of Dogecoins out there.
Yeah.
And it costs 50 cents. It doesn't make any sense.
Yeah. This is Dogecoin, by the way. Oh, it's hit a new high. Look at that.
Yeah. Dogecoin is aiming at the moon.
Yeah, I think my favorite cryptocurrency right now is the Ethereum, because Ethereum has a lot of uses, unlike Doge.
Yes. And unlike Bitcoin, I might add.
Yes. And price of Ethereum has been making higher highs and higher lows. Ideal conditions for the bulls, really, to push this thing up and up. And so far, it's kind of doubled, hasn't it, from its drop in February. I've drawn the extension levels there, but if you zoom out a little bit, going to the weekly chart or something, where's the weekly? Here's the weekly chart. You can see that it's taken out the 2018 high and it held above there and it's shot higher. So if you draw the Fibonacci extensions from this high to this low, we might get some objective levels to see where it might come under a bit of selling pressure or profit-taking pressure. And as you can see, it found some resistance at the 127 extension and then resistance at the 161 extension. It's gone through the 200. The next Fibonacci-based extension is the 261.8 at just over $4,000. Could it get there? I wouldn't bet against it. I certainly wouldn't bet against it. So
in these moves that are directional, you generally don't want to go against the trend.
Look at the strength of the rally. Like every time it goes down, even on the 60-minute, this is a 4-hour chart, but if you look at the 60-minute chart, every sell attempt has been bought, and then once this high broke, look how shallow the retracements have been. It's had an attempt here to break down, but now it's come back all the way up to test the recent highs. So you get the picture. It's looking quite strong at the moment, and I wouldn't stand in the way of this. But yeah, Bitcoin, as you mentioned, has been finding some resistance, and it's been all over the place in the last couple of months.
Certainly
which is
has.
like I was gonna,
I was gonna say that some proponents of Tesla have been, screaming and shouting how Tesla is buying Bitcoin, so on and so forth. Well, during their last earnings call, we saw that they sold 10% of their Bitcoin. So
I can't believe they got away with that. They pumped Bitcoin up, and then
well, I think there is something for the SEC to look at here.
Absolutely,
this is absolutely insane.
I mean,
at some point in time, there's going to be a complaint, and somebody's going to have to address it.
Yeah,
I feel like there is a risk here that is too big to ignore.
Yeah, but we leave you with a chart of Doge. No joke there. Just stare at this, and I mean,
some people are calling it Dogecoin.
Yeah,
you might play around with the spelling a little bit.
Yeah, absolutely. Thank you so much for joining us. I hope to see you again next week. Now, for those of you who joined us on YouTube, make sure to join us live next time. And you can do that by going to our website and go to Market Analysis Live Webinars. And then here you will see all the upcoming webinars. We've got the non-farm payrolls preview coming up this week on Friday, 11:30 London time. Make sure you join us for that one. We will be providing a preview of the US jobs report and talk about which markets you should be concentrating on and what levels to watch. So join us for that. Until then, see you.
See you. Goodbye.